Hey everyone, we're gonna get started in 1 minute. Welcome to our final class of Biz 133. So it's gone by pretty quickly, at least from my end. Um, since there were no assigned readings for this week, I'm just gonna go right into kind of the slides, and then what I plan to do is just leave time at the end, hopefully more time than we normally have. And if we go a little bit over on the last one, I'll kind of go a little bit longer. I know a lot of people had questions they submitted in the discussions on Canvas and stuff like that. Um, this week, I kind of wanted just people to ask the questions, for our last class, and then, any ones that doesn't get asked or anything like that, I'll just then answer on Canvas. So let me go ahead and start the slide share, and then I think people will be joining, but we'll get started. So 1 second. All right. So anyways, oh, and by the way, I know the lecture from last week had, first it didn't record, and I guess I re-recorded the lecture component of it, and then I think even then the audio kind of was having some problem near the end of it. I don't know what was going on. So I will probably end up re-recording the class 7 lecture, or at least those last 15 minutes or so, again. So hopefully that'll get posted. Everyone can hear me right now? Everyone can see the slide share? Okay, good. So anyway, so let's get started. So last week I told you I was going to go through 2 case studies, but then there was a couple of requests on Canvas to go through, like, just use a real world example of Gordon growth. And frankly, since Nvidia's on top of everybody's mind and they just reported earnings earlier tonight, I decided let's just do Nvidia, since that's what everyone cares about. So I'm going to go through kind of just a quick example, on how to think about Nvidia through a Gordon growth lens. Then we're going to do the case study on Meta. Again, it'll be a quick, it won't be as long as the one we did on Coca-Cola, but just to show you that, some of these opportunities do arise, in more recent times, not just, Coca-Cola happened in 1988. These opportunities still come. And then I'm going to spend the last part of the class just kind of hopefully tying together the main ideas from all the different weeks, so that you can kind of see how, if you don't see already, but try to see how they kind of all kind of fit together. So hopefully we can use the last part of the class to really bring this whole investment perspective all into one. And then, like I said, I'll leave time at the very end for discussion and all that stuff. So Gordon growth applied. So real quick, here's Nvidia. This is as of literally this few hours ago. You can see their income statement. It's in some ways a very beautiful income statement. $57 billion of revenue. Very high margins. $30 billion of net income. $31 billion, almost $32 billion of net income in the quarter. And Nvidia has about 24.5 billion shares, diluted shares, which you can see at the bottom. Now the balance sheet also, here's the latest balance sheet. So right off the bat, what I would point out is the first item: cash and cash equivalents and marketable securities, about $60 billion of cash and marketable securities. The rest of the balance sheet is pretty standard. And then there's a line item at the bottom, 11.7 billion, that they call other assets, which I'll talk about in a minute. And then they have short-term debt of about $1 billion and long-term debt about 7.5 billion, so $8.5 billion. So when I think about net cash, which is just the cash, the $60 billion minus the roughly $8.5 billion of debt, so net cash is about $2, a little over $2 per share. Now, we talked about the other assets. So we know, if you pay attention to the news, Nvidia is obviously making investments in a bunch of other companies and stuff like that. And so if you look in their 10Q, which they actually did file today, they have a note called the fair value of non-marketable equity securities. So non-marketable equity securities basically is their investments in private companies. And so the first thing you see is the non-marketable equity securities are recorded in long-term other assets. So that other asset line item that I highlighted on the consolidated balance sheet. You could see that their carrying value of their investments right now is about $8.1 billion. And they have a net gain of 1.4 billion on that. So you could think of it as a little bit like 9.4, 9.5 billion. And then they also have a loss of 167 on some other investments. So net, it's about $9.4 billion, which is surprisingly only 38 cents per share because they have so many shares outstanding. So let's look at kind of the earnings that NVIDIA put out tonight. So they reported a pre-tax EPS of $1.57 or $6.26 if you kind of annualize that. The EPS was $1.30 or $5.19 if you annualize that. And the net cash plus investments is the $2.13 that I said was the net cash plus the 38 cents of investments that they have are $2.51. So now that we have that, how should we think about it from like a Gordon growth lens, what we've been talking about, right? So just as a reminder, here's the Gordon growth equation. This is the way I like to use it. Implied return R equals the earnings yield, right? That's the more certain component of your return, plus G, the perpetual growth rate, which is the less certain, more riskier component. But you can rearrange that equation, right? So you could, price is equal to the earnings over R minus G, or the discount rate, the implied return minus the perpetual growth rate. That's another way to rearrange it, and we'll use both in the next few slides. So right off the bat, we say, well, where would NVIDIA be if we thought it was really a treasury bond? Right. So if NVIDIA was a treasury bond, what would it look like? So here we can see what would it be worth. So $5.19 is sort of the net income that we talked about. A treasury, right now the long treasury yield is about 4.7%, and there's the treasury doesn't grow, so the growth rate is 0. And so that would say that it'd be worth, if it was a treasury bond, or if we thought of it in that sort of a format, it'd be worth $110 and change. And if we took the $110 plus the $2.51 of the cash plus investments, the non-core assets of the business, you'd have $113 of value. Now, instead of a treasury bond, what if we really wanted NVIDIA to be more like a corporate bond? Well, we basically do the same thing, but instead of the 4.7% yield on treasuries, right now investment grade corporates are around 5.7%. So we use a 5.7%. Again, a bond, the coupons on a bond don't grow, so the growth rate is 0. And so that gets you a $91.05. And then again, you add the $2.51 of cash plus the investment, so $93.56. So if NVIDIA traded at $93.56 and we thought, it would at least maintain the $5.19 of earnings, we would kind of think of it as being very equivalent to a corporate bond we might be able to buy today. Now, what if Jensen Huang decided tomorrow that he wanted to do an LBO of NVIDIA? So now here we use the $6.26 of pre-tax EPS because interest is deductible before taxes. And so, we look at the pre-tax income here. So $6.26. Now, if he's doing a levered buyout, he's probably going to pay a higher rate. He's going to probably pay something like a junk bond rate, which right now is about 6.7%. So, you get to $93. Okay. And again, if you add in the $2.51 of cash and investments, about $95 or so. So if someone like KKR or somebody like that wanted to buy NVIDIA, not that they could, but if they wanted to, maybe this is a price that they'd be willing to pay, right? So just all I'm saying is, I'm not saying that this is really what NVIDIA is worth, but I'm just saying that if you thought of NVIDIA as looking like a type of a bond or a levered buyout, these are the kind of levels, the stock prices today where it would, trade. Now, we also talked about Buffett, right? And where would Buffett maybe want to buy a stock like NVIDIA if he were to buy a stock like NVIDIA? Well, again, if you remember from what we talked about before, he says he looks for a very high probability of a 6.5%, 6.5 to 7% sort of earnings yield, with, the upside from the growth, but he doesn't really count on the growth. So again, you take the $5.19, 6.5% earnings yield, get you to $79.85. And then again, you add in the $2.51. And so you get to like about $82, right? So, when we sort of think about maybe what's a price that, a value investor, a deep value investor like Buffett would maybe get interested in NVIDIA, where you're not really paying for the growth, and earning a return that at least he finds acceptable, 6.5%, this is kind of the price that he would pay. Now, let's just say you're different, right? You actually say, wait a minute, I'm confident. I know that NVIDIA is going to grow. And, not only am I confident, but I'm actually fine accepting 7% long-term equity returns, right? And why do I say 7%? Because when we talked about Peter Lynch's kind of rule, he basically took the dividend yield of the S&P 500, which was about 1% today, and he added about 6% for growth, right? So that was how he estimated it. So that would give you about 7% today. So Peter Lynch probably thinks that the equity markets today are giving you about 7% growth. And, we've talked about it in the past, like why, we can't assume really, really high growth rates for perpetuity. I here took the assumption of a 4% perpetual growth rate, saying that NVIDIA would continue to grow in line with just overall GDP in perpetuity. If you do this math, you get to $173, right? Not too far away from where, the stock is trading. I think it was at 195. So if I take the 173, again, add in the $2.51 and change of investment, so $175. So $175 is the price where if I thought two things, right, or at least I thought one thing, right? One is that NVIDIA will continue to grow forever and be able to maintain a perpetual growth rate similar to the overall economy. And two, I'm willing to accept a 7% long-term return. Then this is kind of where I'd be willing to buy in. Now, if you instead say you want historical equity returns, let's say closer to 9% in the stock market, again, with still the 4% perpetual growth, right? That gets you to $103, $104, let's say roughly. And then again, adding in $2, so $106. So if you really want to make kind of long-term equity returns similar to what the market historically said, you need to wait a while for one of two things has to happen, right? Either NVIDIA has to grow a lot more, or you got to wait for the stock price to adjust. So let's go back to now, kind of my version of the Gordon growth equation, which I like, which is, looking at the return as the function of the earnings yield plus whatever assumption I'm willing to make for growth, right? And so here you can see that the earnings yield of NVIDIA is about 2.7%. And then if I just kind of assume a perpetual growth rate of somewhere between 0 to 4%, right? So I don't think NVIDIA is going to decline. I don't think it's going to go away, but I don't know where it's going to grow. So that kind of gives you a range, right? Somewhere between 2.7% and 6.7% is kind of what, the long-term, these are the long-term implied returns if you're an investor, not a speculator, right? If you're an investor, these are the long-term implied returns when you're buying NVIDIA today. As hopefully, as you remember, and we'll talk about more when we were talking about, John Maynard Keynes and the state of long-term expectations, right? the market is to a large extent buying things not for investment value, but buying things because they think the near term news is going to be positive and they're going to be able to buy something today and turn around and flip it to somebody else, right? But if we're thinking about it from the perspective of intrinsic value, meaning this is the price of an asset, or this is the return we'd get if we bought an asset, if we could never sell, this is kind of where the math gets you to. Now, the question that people have asked is, well, is this a good return? Is this not? And what what I've said is that's really very personal, right? For a lot of people, making 3%, 4%, 5%, 6% would be completely fine, and that's an acceptable return to them. And to other people, they'll say that that return is not where they want to be. So that's where the market, but we can see at least what the market implied return, at least a range what it is, right? So at least hopefully that kind of gives you some perspective. Now, the other thing, and hopefully this has come through, right? But the other thing that we really want to be, and at least from my perspective, when I think about like Buffett and others, I think one of the reasons why they do not place overemphasis on the growth function is because, frankly, the future is very unpredictable, and as we saw, experts are really, not very good at predicting the future. Lots of things can change. So, when you think about like, oh, I'm really confident in the long-term future of a company like NVIDIA, right? Maybe here's a couple of things that you should think about, when you're answering the question, right? Um, Customers and competitors, will they or won't they develop competing chips, right? We know today you have Broadcom, Marvell, the hyperscalers, all trying to develop, TPUs and different types of chips. Maybe they'll catch up to NVIDIA, maybe they won't. Um, but also maybe the AI models, right now the assumption has to also kind of the embedded assumption has to be that they either won't become less reliant or become more efficient with their use of GPUs, right? That's what happened when DeepSeek first came out earlier this year. Feels like forever ago now, but DeepSeek, I think the reason why you saw the stocks like Nvidia sell off is because DeepSeek at least did what they claim to have done is did it with very little GPUs and not even the most cutting edge GPUs. But even if you can kind of get comfortable with those, right, you have to answer, well, do I think that the companies will continue to spend at current or higher levels forever, right? So Mag 7 CapEx is going to reach, $500 billion, $500 billion next year, right? Can they keep spending that level for forever, right? And will all those dollars go to NVIDIA and all these other things, right? Let's say you think that that's the case, right? Well, right now, they're depending to some degree on financing, right? A lot of these deals now are being done with debt financing and things like that. So, will the financing for the AI infrastructure build out remain? You know, Something to think about. I'm not providing you an opinion here. I'm just kind of providing you questions to think about. This is all obviously a question. Will a lot of the large language model companies become profitable, right? Today, the companies are all burning cash. The assumption is that, there'll be financing for them to keep growing, to keep building, to keep burning cash, but at some point that they'll become massively profitable. Um, what about power, right? We have to think about some of the physical bottlenecks, right? Power will continue to be available to build data centers, right? You're already seeing in certain states like New Jersey, where I am, or Virginia, where some of the residents are starting to complain about what's happening to their power costs, and government potentially stepping in to regulate building data centers. Um, you know, Here's an assumption: NVIDIA will catch the next technological leap, right? So you had a massive leap that happened with AI. GPUs were well positioned for what happened. Um, I personally don't know what the next technological leap would be, but you have to make an assumption that whatever that next technological leap is, NVIDIA would be potentially part of it, right? The next CEO will be as good or better than Jensen Huang, right? I'd say today, most people who've been invested in NVIDIA kind of have a good sense that, Jensen Huang saw kind of the rise of AI, the rise of accelerated computing, and really positioned his company, and probably a lot, deserves a lot of credit for being a visionary. Um, you know, there will come a time where he won't be the CEO, and so the question is will the next CEO really be visionary? Um, you know, China won't invade Taiwan, right? Today, at the very least for today, right? All the chips are manufactured by TSMC, primarily in Taiwan. Will you continue to be able to have access to those chips and not have some geopolitical upheaval? And then last is the question marks, right? What Donald Rumsfeld called them the unknown unknowns, right? The things that we don't even know to think about, right? And so, hopefully at least this kind of makes you think about like how many things, and I think when you look at, when we talk about like Buffett and Coca-Cola and things like that, right? The reason why you could get comfortable, or maybe Buffett could get comfortable investing in Coca-Cola is A, the valuation, right? He was buying at a valuation where you didn't need growth in the future. But two is, when you think about that product versus, not a technologically demanding product, not an expensive product, a consumed product, things like that, right? Lots of things there that probably made you a little bit more comfortable underwriting the growth. Whereas for something in technology, maybe it's a little bit more uncertain. So let's talk. I'm sure there'll be questions about this at the end, but let me just quickly go now and just talk about Meta, which is kind of one of the case studies I wanted to do to specifically talk about. This is a recent example and show you kind of, these opportunities do arise. These aren't just things that happened in the distant past in investing. These are things that happen, you know, you can find these opportunities today, right? So I think pretty much all of us know what Meta is, right? It's one of the leading, if not the leading, social media companies. Here are their properties: Facebook, Instagram, WhatsApp, Messenger, Threads. Actually, somebody reminded me today they even have a new app called Vibes. Um, they reach about 3.5 billion people every day, so pretty extensive reach, and they generate revenue pretty much through targeted digital advertising. So in 2002, I mean, sorry, 2022, right, Meta comes under attack, right? So a couple of things happened, right? So first, Apple changes its privacy policies. I'll talk about that in a minute. Second, they started to face more and stiffer competition from TikTok, which I don't use, but I know a lot of younger people love. And then third, they were spending heavily on the metaverse, right? We were all going to plug into some headsets and all live in a digital world. So let me just really kind of just briefly, and again, I'm not going to go into technical detail, but briefly explain what Apple did. So Apple changed a policy called app tracking transparency. So before app tracking transparency, or before ATT, Meta really relied on what they call cross-app and cross-site tracking, right? So what they could do is they could see when you were off of, when you were outside of Facebook or outside of Instagram, what else you were doing on your phone, what you were buying through the browser, or you might see an ad and then you go to the Amazon app and click on it and buy something, and they'd be able to see that, right? And so what did it do? It enabled for highly accurate targeted advertising, right? Because advertisers basically could see almost instantaneously, right, which ads drove purchases or app installations, right? And so because of that, they could optimize campaigns and generate really high returns for advertisers. This is, I think if you talk to most people who do digital advertising, social media and search advertising are really the two best forms of advertising, and that's why Meta and Google are, some of the two biggest companies. And so what happened, right? So after app tracking transparency, so you guys probably remember, it was a couple years ago, but all of a sudden when you started using an app, you got a little pop-up saying, ask, give it permission or ask the app not to track, right? And so they lost visibility for off-platform user action, right? So they could no longer see what you were purchasing or anything you were installing, as long as you did it outside of the Facebook, Instagram, app, right? If you were, like Facebook has Marketplace or Facebook Shops or something, if you were buying just within the ecosystem, they could still see that. But if you were leaving the ecosystem, you couldn't. Right. So advertisers struggled really to measure results. What we call direct response ads, right? So you see an ad and you take some action, right? Not, the other type of ad is called a brand ad, where people just advertise a brand and they try to build up, sort of, you know, goodwill and loyalty with the consumer over time, right? So the direct response ads became less efficient and they lowered the advertiser return on investment. So advertisers were spending a certain amount of money, thinking they were going to get a certain amount of return, and that number went down. And so advertisers reduced spending with Meta. At the same time, TikTok was rapidly gaining time and attention, right? Um, and importantly, it was happening mostly with the highly coveted younger demographics, right? So people, lots of companies are always trying to get in with the younger consumer, especially if you're a company that can offer products throughout the life cycle. If you get the consumer early, you might have a consumer for a very long time. And really, it just is very simple, right? Advertisers shift the dollars to wherever users are spending the most amount of time, right? If you're spending more time in a certain app, they'll spend more money because it'll be more lucrative to advertise. And so you see a sharp decline. And trust me, it was a very sharp decline. So, you could see Meta went from about almost, let's say $375 to at the very bottom, I think it bottomed at around $88. So, lost a tremendous amount of value in a pretty short amount of time between kind of, middle of 21 and kind of end of 22. So where was Meta trading at that point? So what's interesting is their pre-tax EPS was about $13.16. Their EPS was $10.73, and they had net cash per share of about $11.85. So when we look at that, the pre-tax earnings yield was about 12.5%. So kind of depending on if you use the absolute high, absolute low, between 10.3 and 17.1%. That was kind of where it was at the end of end of 22. To put that in perspective, the yield on treasuries was 3.9%. And Meta had just started issuing debt and they were borrowing at about 5%. So, and just so you can see the calculation. So I took the $13.16 of pre-tax earnings. The average share price in that fourth quarter, I didn't use the low, I didn't use the high, I used the average, was $117. And then, like I said, they had $11.85 of net cash. So I backed that out to get you the kind of the implied earnings yield on just the core business. So about 12.4%. So let's look at it on an after-tax basis, right? So on an after-tax, the yield was about 10%. Again, the 30-year treasury was 3.9%, and Meta was borrowing at about 5%. So here's that same calculation. Instead of pre-tax earnings, I just changed the numerator to after-tax earnings. Everything else is the same. And sorry, this is a typo here. It should be 10.1%. So now, it seems like everything was pretty bad. And, first to say that it wasn't great, right? But it's actually interesting when you look at the data. So the monthly active users, so how many users use one of Meta's properties in a month? Now, you can see it was still growing. It obviously had slowed down its growth pretty dramatically. but it was still it hadn't declined, right? People weren't leaving the meta universe, the meta platforms sort of universe, right? Now, part of it also you have to remember, right? There was a significant amount of growth that happened, during COVID, and so there's obviously the competitive threats from TikTok, but I think also there was probably some pull forward of people starting to use the app, and so that natural growth probably had to slow down because you pulled forward demand a little bit. But so that was, maybe not terrible, not great, but not terrible. The other thing that was interesting is engagement was still pretty high. So now Meta used to provide this information. They actually don't provide this information anymore. But what we call DAUs, divided by MAUs. So daily active users over monthly active users. So how of all the people who use Meta at least once a month, what percentage of them actually use it every day? And what's interesting is you can see that kind of the numbers really range from about 65% to 67, 60, maybe 67.5%. But they'd actually not fallen, right? Which is again interesting to think about because here's an example where people were, in some cases, if you were worried about TikTok or something like that, taking a lot of engagement away, well, the data didn't support it, right? So the engagement was holding in. Um, and ad impressions were still growing. So when you look at the number of ads that were being shown, how much it was growing year over year. So they were able to show, again, 15%, 20%, ads, which is basically their volume, right? So that all was going pretty well. The other thing is, again, we talked about they were spending heavily on the metaverse. So here is, the annualized spending between both OpEx and CapEx that Meta was doing. And so you can see that, by the kind of end of 22, they were spending close to about 110 billion, 110, maybe close to 115 billion dollars, sort of per year, right? And just rewind back, even a year, and they were spending, maybe closer to like $90 billion, right? So they really started to spend a lot. And the question is like, was all that spending, really valuable, or was there room, to kind of moderate it, right? When you're running apps and social media networks and things like that, how people intensive are they really? Now, obviously, you're also investing in things like new products and R&D and stuff like that. But you know without knowing anything and without going to the inside of the company, you could probably have a guess that there was at least probably a few dollars you could cut. The other thing is when you look at the history of Meta, this is a company that actually had a history of facing and being able to overcome challenges. So, if you look from 2012 to 2014, I mean, it's hard for us to remember now, but Facebook was really a desktop platform. They really had a very, not very well suited mobile platform. And so really they ended up pivoting pretty hard, rebuilding the Facebook app for mobile. And that really, really kind of helped them as, everyone transitioned from desktop to mobile. Between 2014 and 2016, people viewed Snapchat really as a big threat, um, especially again with the younger demographics. Um, so what did Meta do? Right, they kind of copied them and launched something called Instagram Stories. Um, 2018, there was a scandal with Cambridge Analytica. Um, so again, people, at that time, people thought like everyone was going to delete Facebook. Facebook really kind of responded by putting out better privacy tools and letting people kind of be more in control of what they could do. And then this time, obviously the app tracking transparency asked the app not to track. Okay, So how does Meta respond? Well, they came out with something called Advantage Plus. They basically invested heavily in AI to help recreate the signals that they had lost from, that they were getting before from the app tracking. Um, and they've helped to create more automated ad campaigns. Um, they also launched something called Facebook Shops. So remember, you know, they could continue to see what was happening within their universe, right? So, what they tried to do, and again, I don't think they've been super successful, but at least they tried, is they tried to get more people to sell within Facebook so they could at least show that like, hey, we're showing an ad and then the person's going and staying within the app and completing a transaction. And then, like we said with TikTok, again, they responded by creating Instagram Reels, their version of TikTok, or their competitor, at least to TikTok. So, at least, you didn't know for sure, but at least this company had a little bit of history of facing challenges and figuring out ways around them. And then in 2023, you know, Mark Zuckerberg, he said this is going to be our year of efficiency. So, we talked about, was there a lot of room to cut costs? And in fact, there was. Meta reduced their headcount by 24%, 21,000 people. They started prioritizing. Well, not only did they cut headcount, but they also reduced a bunch of layers of middle management. Really to kind of speed up decision making. They prioritized AI, Reels, and rebuilding their ad technology. And they started controlling. They didn't stop spending on the metaverse, but they started controlling how much they were going to spend on the metaverse. And you'll see, but ad impressions continue to grow, and ad pricing, which had started to go negative, because the ads had become less effective, finally again inflected and became positive again. And they started cutting some costs, probably while they were spending, but not a significant amount. So here is the ads impressions growth, so that those numbers continue to grow. So that, just think of that as demand or volume, right? So volume continued to be pretty healthy. And here is pricing of ads. So this is where the price of ads were going. And so you can see a couple of times ad pricing had gone negative. So in 2019, it went negative because they were shifting more of their ads to stories. And the stories, the price were lower for ads on stories because it was untested. Obviously in 2020 with COVID, there was less need to advertise online, and so ad pricing was negative then. It rebounded in 21 as kind of economy started to open and things like that. And then you can see in 22, right, ad pricing, even though ad impressions remained very strong, ad pricing started declining. But then really kind of at the beginning of 23, the decline started to moderate. And then by the end of 23, they started to go back up, right? Slightly, but they started to go back up. Effectively kind of showing that the new technology was at least able to kind of, improve the returns that advertisers were getting, even with the change in Apple's privacy policies. And, here's the rebound in the stock, right? So, the average price of Meta went up, 300, almost 400% between the end of 22 and the end of 24. So in the span of 2 years, right? Yes, was there risk? Yeah, absolutely there was risk, right? There was a chance that, they might not be able to figure out or counter ATT or TikTok, but like I said, there was a company that also had a history of overcoming challenges. And then the other thing, at least you should at least think about is, these policies, they impacted all digital advertisers, right? Not just Meta. And, you know, um, even if it reduced the value of digital advertising, it was probably still the best way to advertise, right? When you think about newspaper advertising or television advertising or things like that, it's much harder to audience segmenting and targeting. So even with all these changes, and probably some amount of adjustment that digital advertisers needed to undertake, it was probably still the best format for advertising. And then with TikTok, obviously, at that time, there was already talk about, what would the U.S. do with the fact that TikTok is owned by the Chinese? Was there a chance that TikTok would get banned or limited or anything like that? And obviously, we kind of now know what's happened, but at the time there was always that potential. And so let's look at what happened to the price, the share price drivers, right? So EPS, pre-tax EPS went from $13 to $27, right? EPS went from $10 to $24, right? The cash balance actually increased, and the pre-tax earnings yield really went down dramatically, went from 12.4% down to 4.4%. And the after-tax earnings yield went from 10 to, again, like 4%, right? So when we think about it, right, like I said, the stock price went up almost 400%. The earnings went up about 100%, right? They basically doubled in 2 years, which is fantastic. That's great. But really, the driver of it was the high starting yield, the very low starting PE multiples that Meta traded at, really was a big source of the growth in the stock price. So, again, I will leave questions to the end if anyone wants to ask questions about the Meta case study. And what I wanted to do now is just kind of switch to the last part, which is kind of tying all these past 8 weeks together. So the lessons I wanted to kind of have you leave with is, when we think about week one, right, active investing is a loser's game, right? And I won't go into a lot of detail, right? But the way, if it is a loser's game, the way at least I think it is, right? The way to win is by not playing very often, right? You should sit still most of the time and only play when, you have a glaringly obvious opportunity. So, I'm going to steal this from Buffett. Buffett talks about Ted Williams. Ted Williams wrote a book many, many years ago called The Science of Hitting. And, people ask, well, why were you such a good baseball player? Why were you such a good batter? And he says, well, it's only because I swing only when I see balls that are in my sweet spot. And he actually created this diagram with, I think it's 72 circles, and he kind of measured what his batting average was when balls were at different parts of the circle, or were different parts of that grid. And really, I think the same lesson sort of matters for us, right? Only when we find companies really in the sweet spot, right? Both in terms of valuation, in terms of durability, in terms of things that we can understand, really should we be investing. And if we do that, maybe we'll become the Ted Williams at least of investing. The second lesson, and again, I don't think we can appreciate this much, enough, is liquidity really distorts how people think about investing, how people think about markets, right? If you remember from week 2, we talked about John Maynard Keynes. We talked about the convention, right? People generally assume that tomorrow is going to look like a lot like today, right? And if that convention holds, right, what happens, right? It causes people to really care about where an investment will trade, not what it's worth, right? Because you don't care what it's worth because you can always get out tomorrow if you wanted to, right? The markets are liquid. And so you don't really need to worry about the valuation or the durability of a business, or at least that's how most investors think. But you are very focused on near-term headlines, right? And so you want to buy, most people, the behavior you see in markets is people buy things because they think the near-term news is going to be good. And the assumption being that the near-term news is going to be good, or really they're not even thinking about that. They're just thinking, is the stock price going to go up? And if the stock price goes up, that's great. They'll buy it and then they'll turn around and sell it to somebody else, right? That is probably the best definition of speculation. But what happens is that these distortions create, what we call the equity yield curve, right? Most investors are focused, again, where an investment is going to trade in the near term, And that creates this equity yield curve, right? Which means that investors who can look a little bit further out can capture good longer term returns, right? So really what we need to do is, focus on the things that others are, maybe avoiding, right? We talked about things like dead money or falling knives, right? Professional investors have, their own incentives, right? I talked about the principal agent issues, right? Professional investors who are managing money for others get paid based on near-term performance. So they're always chasing what they think is going to go up and avoiding things that they think are going to go down in the near term. And they also have career risk, right? If they make a bet and it does really badly or they underperform the market significantly, then their clients can pull their assets and they might be out of a job. So, that is why I think that rational, active investors will always be able to find opportunities. It's just we have to operate on a different time horizon than most of the rest of the market. Um, it's not going to be smooth, right? When we're investing longer term, we have to know that we're going to accept some amount of volatility, and we're going to risk looking stupid, at least in the near term, right? Prices are volatile. We talked about the chart. Peter Lynch, observation that the average stock fluctuates 50% between its high and its low, and we saw that even happens today. But if we want to earn, the attractive long-term returns that we think we're going to get, that's accepting the volatility. At least I haven't found a way to avoid the volatility. Um, and again, market timing doesn't make sense, right? Even God can't beat dollar cost averaging. So, that guy can't beat dollar cost averaging. Now, what we should do is we should really ignore the market, right? We should really pay as little attention to market prices as we can. As Ben Graham said, we should really transact only when it's favorable to us. So only when prices are really high, or we want to sell, or only when prices are really low do we want to buy. And most of the rest of the time, they're kind of in the middle where we're sort of indifferent. And so we should remember who Mr. Market is. It's just a bunch of manic depressives, as Benjamin Graham used to say. But if we want to ignore the market, right, we have to be confident. We have to have our own confidence, right? We need to have true confidence in the intrinsic value of our investments, right? It's one thing to say, "Oh, I know what something's going to be worth," but we have to really kind of understand why we think it's worth it, not because the stock used to trade there, the stock is trading there today. In fact, most people succumb to volatility because they don't believe in value, right? So the stock goes down, they don't know that that stock price is too low, and then instead of acting rationally and buying as they probably should do, they panic and they sell. Or a stock goes up, they think they're geniuses, and they decide to buy more, right? So they're probably not acting in rational ways, right? Remember, when we talk about intrinsic value, it's the price of an asset if you could not sell. And I gave you the analogy of, imagine you had a box with just $100 in it, right? You had a box with $100. Think of this as like kind of your stock or your investment. And if somebody came to you tomorrow and offered you $50 for it, right, you wouldn't care, right? You'd be like, no, I'm not going to sell. I know what this is worth. And at the same time, if somebody came and offered you $200 for your box, you would gladly sell, right? So when we talk about developing confidence in our investments, we really should try to think of it using this analogy of the box with the $100, right? Having a very firm understanding of where something is worth, what something is worth. Now, when we talk about intrinsic value, we talked about how discounted cash flow really is the way, right? So discounted cash flow is how to calculate intrinsic value. The problem is discounted cash flow is very hard, right? You have to model out all the earnings, you have to figure out a terminal value, you have to figure out a discount rate, et cetera, right? Same, I also said, kind of multiples, which didn't do the derivation for, right? But all the multiples that people use are basically just derivations of the discounted cash flow equation. But thankfully, we have the Gordon growth equation, right? This equation, which is completely mathematically identical to discounted cash flow, right? But just in a much easier to use format, in my opinion, at least. Now, again, when we're investing, we want to invest with a margin of safety, right? So if you go back to that Gordon growth equation, right, the return equation has two components. One, what I call the safer, the earnings yield component, and then two is the less certain, the riskier growth component. And so a margin of safety comes when you can get an acceptable return from the earnings yield alone, right? Where you don't have to have the contribution from the riskier growth component, right? So you don't need growth to earn an adequate return. And so any growth that actually does materialize will be a very pleasant, right? It'll be icing on the cake. The other reason you want a margin of safety is because the future is very uncertain, right? So you don't want to rely too heavily on future growth for your returns, right? We talked about it. There was the optional reading about Cisco. We talked about the movie studio executive who couldn't predict which movies were going to be hits. The future is very unpredictable, and people are very terrible at forecasting, right? And we also probably shouldn't rely on experts, right? There's lots of data out there. We barely scratch the surface. That most experts aren't really much better, or frankly, not better at all than what I call knowledgeable amateurs, right? So, maybe don't pay too much attention to this guy. And then, lastly, simple really beats complex. People like to make investing very complicated, but hopefully, you've seen that very simple reasoned rules can outperform complicated analysis. Hopefully, I proved to you that Buffett, at least from my perspective, uses a very simple rule and has become a very has been and continues probably to be a very successful investor. And his simple rule is this: do I have an acceptable earnings yield? Yes or no, right? And do I think that the earnings are likely to grow? Yes or no? And that's his simple, at least from everything that I think you're able to piece together from the different breadcrumbs that he's put down. I think that is his simple reason rule. And like I said, it's not just Buffett, but we went through a number of investors: Peter Lynch, Bill Miller, Stan Druckenmiller, Todd Combs, Lou Simpson, right? Who all, Howard Marks, who all, I believe, also use, either consciously or subconsciously use a very similar sort of heuristic for evaluating investments. So with that, I just want to say thank you. I've really enjoyed this class. This has obviously been a pleasure of mine, something I've wanted to do for a long time. I think you're going to get a course survey in the next few weeks. So I really like to teach this class again. So if you could fill out the survey, I think it would be helpful for me, and it would also be helpful to kind of know, there's probably lots of ways I can improve this class in the future. I think your access to Canvas will continue for the next 3 weeks after the quarter ends. So you guys should have access to the videos. If you want to go back, you can still submit messages and the discussions through Canvas, at least for the next couple of weeks. And then, like I said, further on, I'd love to stay in touch with all of you guys. So if you haven't connected with me already on LinkedIn and you would like to, that's my LinkedIn link. You can also find me. It's pretty easy to find me on LinkedIn, and I think I also sent it out in one of the emails. So with that, a very heartfelt thank you to all of you guys for listening to me drone on for the last 8 weeks. I'm going to stop the share now, and we'll open it up to any and all questions that anybody has. So let me close out of here. And sorry, one second. Okay, so
Thank
I
you,
see.
Terry.
I see a few hands. Sorry, was somebody speaking? Okay.
No, I just wanted to say thank you.
Oh yeah, of course. Happy to. Like I said, I've wanted to do this for a long time. So I hope I hope you guys found it useful, or continue to find it useful as you guys are investing. So um, let's start with let's see. I see Joel. I think your hand's up, so maybe I'll start with you first.
Sure. First of all, thank you for the course. When you adjust the price for the amount of cash and marketable securities on hand, should you take into account how much cash you should have on hand to run the business on a, is that
Yes. I mean, if you really wanted to be very precise about it, the answer is yes. Okay. Like the reality of it is most companies are pretty cash general. Again, like if you're talking about Nvidia or something like that, right? Like Nvidia is, gushing, billions of dollars of cash probably per day, right?
right?
So, or fraction at least, per week or whatever, right? So for them, I don't think that you can really say that they need to have a lot of cash on hand, right? Now, if you think about like a restaurant or a retail company or something like that, you would say that some amount of cash, right, they have to just keep in the cash register, right, as, you know, part of the business, right? And so there is some argument that like not all of the cash for every company can be viewed as excess, right? If you remember back to Coca-Cola, right? We were saying that, in that year of 1989, they had like $2 billion of cash. And we said like probably $1 billion of that was excess. That was an estimate. But, the way I looked at it was I just looked at, in the past, how much cash did they keep as a percent of the revenue? Um, that might again not be perfect, but it might be an okay measure. And you can see that, they kind of, over the last couple of years before 1989, they'd kind of bounced around 10% to 15% of revenue, and then they'd gone up to like 20, 25%. So you kind of had a sense that they were sitting on a lot of cash.
Okay.
And
Could
then
you look at something like some portion of short-term liabilities or
Yeah, I mean, I think there's probably some ways to think about it, right? Like, I mean, Coca-Cola was a little bit of a unique example because there was only really that one year where they had a lot of excess cash, but really the other thing, the value in Coca-Cola was really those all those investments that they had spun off, right? Um, so I think that, again, like, going back to the example we did today of Nvidia or even Meta, right? When you looked at the share prices, the net cash is, you know, relatively small. I mean, at the bottom for Meta, it was like 10% of the value. So I don't want to say it was completely small, but it goes back to kind of the whole analogy, right? Which is like, we're not trying to be, we're not going to be right to the decimal point, but
right?
at least kind of puts us in the right zip code. But you can probably look at lots of different ways to think about how much cash a business might need. You can look at other competitors, see how much cash that they hold. Again, as maybe a percent of revenue or percent of assets. There's different ways you can kind of probably look at it, but you can just use it to maybe roughly triangulate to where you go.
Right. Yeah.
Lastly, what I would say is again, I think most, if not all of us on this call are individual investors, but you'll be surprised at how many times you can just email the company in investor relations and you can just ask them a question. They may not answer always, right? But you'll be surprised. I think at least I've been surprised how many times I've been able to get answers, even from large companies, just asking questions like, how much cash do you need to run the business and things like that. So sometimes you can get a more direct answer just from the company too.
Thank you very much.
Of course. Suraj, I see your hand, and then I'll go to MD.
Yeah. So my question is around. So suppose. So basically, like if you get an opportunity like Meta or something similar, right? So how much do you like? How much of the portfolio size should you invest in that? Obviously, there is not like hard and fast rule, but means some rule of thumbs like maybe maximum I can go is 10% because like if I put like way more, I can still be wrong and lose most of my net worth, right? So if I
Yeah, yeah. I mean, so so I'll tell you this, right? Like I like to rightly or wrongly, right? I kind of think about like what is the Buffett price, right? Like, if he's like the deepest value investor I know or something like that, right? And I think about like, okay, what is a price where I think like even a guy like Warren Buffett, even if he hates technology or something like that, might get off the sidelines and say like, okay, this is just too good to invest in, right? And I think that will at least help shape like where your downside is, right? So, again, in the example of Nvidia that we just did today, I calculated maybe the Buffett price is, 50% below where Nvidia is trading today, right? So at least one way to think about it is that's maybe your capital at risk, right? If, the buyer of last resort is someone like a Warren Buffett or somebody like that, right? Like, if I was buying Nvidia, maybe, I could lose 50% of my money, right? Not that it's going to happen, but, or, hopefully it doesn't happen, but, that you could think of it like that. And then you could say, well, if I'm going to lose 50% of my money, what is the amount of my portfolio that I'm willing to risk where, if I did in some theory lost 50%, how much capital am I willing to have at risk? And that comes a little bit to how confident you are and, your own personal risk tolerances and things like that. But, if you said, look, I could lose 1% of my capital and yeah, I would hurt, but I wouldn't feel terrible. Then, you could make it a 2% position because, if you lost 50% of 2%, you'd have a 1% loss of your portfolio. Some people would say, I'm fine wagering 5% of my portfolio, right? And so if you wager 5% of your portfolio, you'd say, okay, maybe it should be a 10% position, right? So it comes down to really, your level of comfort and how much capital you're willing to put at risk. And two, kind of how much capital you actually think is at risk, right? Like what's the burn down downside, right? Like, you know, in the example of Meta, right? Like it was trading at $80 and you thought like nobody is ever going to come and buy this company, but they had $12 of cash, right? You could say, okay, maybe my risk is really going from $80 or $90 to down to $12 or whatever, right? But the business isn't worth zero because it has cash, right? Forget the fact that they have other assets and everything else too, right? Like if you really wanted to be very conservative, and things like that. So, I mean, those are some ways to at least think about how you'd want to size a position, really, just thinking about how much you're willing to risk and how much downside you really think it has, right? Now, like I said, it's, the thing you have to also remember, right, is there's so many people out there. Now, Meta or Nvidia or whatever, these are very large companies, right? But if you're looking at smaller companies, right, there is a price where strategic buyers, leverage buyout, private equity types would just say like this thing is just too cheap, right? And that's why we look at like kind of where the earnings yield is. And so we say like, okay, if interest rates today, today you could probably do an LBO at like 7% interest rates, right? So if you can see like something trading at a 7 or 8% or 9% pre-tax yield, or it doesn't even have to trade there, but you can see what the price would be for it to trade at that level. That could at least give you a sense of like, okay, if it went down to this level, probably at that point somebody would just try to buy it just from an LBO perspective or something like that. Not to say that they will, there's lots of companies that private equity doesn't buy, but at least it gives you a little bit of, fundamental kind of underpinning of where something could trade on the downside, if that makes sense.
Yeah, I think that makes sense. But my second part of the question was, so for a as an individual investor like me, so I mean, most like maximum that I can know about, like maybe 30 or 40 or 50 stocks, like which I might be using on a daily basis, like in terms of the business and everything that I might be like somewhat familiar with. So in a 2 3 years of time frame, like out of those 40 or 50, only 2 or 3 might go to that level. And if I'm just investing like maybe maximum 10% of my portfolio in each of them, then I'm having like way too many less opportunity to invest. So that's where I'm like trying to uh, uh, think it through, like what other things like I can, like suppose like 30%, like if I in 3 years I found like three of those opportunity and I invest like 10% of my portfolio in each, but still my 70% is still sitting on cash, or should I invest in index, or should I do like, what should I do basically?
Yeah, I mean, again, like that's where I said, like, my recommendation is you should just invest it in a broad, index, invest passively, right? That's really the lesson from from week one, really, is, look, if you invest passively, right, like you're already going to do better than all the active managers combined, right? Um, and so really when you don't see, when you're not in a target rich environment, right, and you don't see a lot of opportunities, right? Like I know obviously, you look at Berkshire Hathaway, right? They just keep piling up cash, right? And we talked about, is that the right way? Is that the wrong way? I think there's, if you look at all the historical analysis, right? Even God can't beat dollar cost averaging. To me, it tells you that, you should probably just, if, whenever you have cash and you don't have good investment ideas, average into the market, right? um, I use the caveat with, there's only those few times where, equity returns were noticeably, or pretty obviously, worse than bond returns, right? Like what we talked about, like, when, we, that article, Mr. Buffett on the stock market, right? When he was writing about the stock market in 99, right? And he basically came and said, like, look, long-term equity returns are probably 6% or so, right? And bond returns at that time were 6%. So, that was, and it was right? It did not turn out to be a great time to invest in the stock market, right? Or, Peter Lynch talked about it in the 80s, but really just because, bond yields were so high, right? So, if we're in one of those scenarios like that, I would say that maybe you don't want a dollar cost average into equities, and maybe there's other asset classes, but, you know, it's gonna be very, probably very rare in our investing careers. Most of the time, it'll probably just make sense to, keep averaging into the broader index, whatever index you want to pick. I'm not saying you pick the S&P or the Nasdaq or anything like that, but, find an index that you think is a good representative of, what the market you want to track. And there's so many ETFs now that it's pretty easy to do. And then continue to scour for those opportunities, right? But be like Ted Williams, right? Don't swing your bat very often, but when you do swing your bat, hopefully you're gonna make a lot of money. MD.
Yes. Jay, my question is about today's lecture. The NVIDIA, like the way you have done the pricing as well as the equity return. I find that like my belief is that NVIDIA will, in the short run, there will be high rate of return, and in the long run, like say up to the judgment day, whether it would be a sustainable company or not. This is the two issue I find. How to accommodate these two issues into that equation?
Well, sorry, I'm getting a lot of feedback. So just to make sure I understood your question correctly, you were saying that you think that NVIDIA is going to be a high return stock in the near term. And,
Yes.
and so I guess what I would say is, but what, like, why, like, what is the rationale that you have for why do you think that? Like, you can't just say like, oh, I think it's going to be a high return. You have to explain to me what it is, why you think it's going to be a high return, right? And then if that's really what you believe, then who am I to stand in your way, right? Just make that decision. But like, just all I'm trying to do is I'm trying to give you the tools so that we're going from the point of, oh, oh, this stock is going up and it's done really well and everyone's really excited about, NVIDIA or whatever, we're just using NVIDIA. You could talk about a million companies like that. But to me, that really gets back to what we talked about before, which is, on one hand, you have what I call investing, and on the other hand, speculation. And I'm not saying speculation is wrong, right? It's just a different skill set, right? Where you're buying something because you think you can sell it to somebody else at an even lower implied, expected return, or effectively a higher price, right? Or higher earnings, higher multiple, things like that, right? That's the difference between those two is just that's the difference between investing and speculation. Remember, investing is, would you buy this company if you could never sell it? And speculation is, I'm buying this company purely because I think I can turn around and sell it to somebody else, right? So, again, this goes back to also what we talked about with Keynes, right? Keynes says, most of the market is very focused on, the near-term news, right? So if you're really confident that the news is going to be positive, right, in the near term, right, NVIDIA is going to say $500 billion of revenue, and then they're going to say $1 trillion of revenue. Let's just use that example, right? If you really believe that, or if you have a real reason to believe that, then you should buy it, or you at least can buy it and use it as a speculation to sell to somebody else, right? But I'm just trying to equip everyone here with the tools for how to view the investment merits of a different security, or at least know when you're buying a security, like what you're actually getting, why are you buying it, right? Like, are you buying it because it has real investment merit? Are you buying it because it has speculative merit, right? They both are merits. I'm not saying one is right and one is wrong. I'm not passing judgment one way or the other either. I'm just letting you know that that's what it is. So if you believe, but again, you have to go back to say, what is it that you believe, right? Do you just you just believe in AI, and all these things are going to continue to go up? Lots of people are investing on that merit, right? And, or at least trading or speculating on that basis. So, that's always doable. I'm just here to try to give you the tools to kind of at least be able to put it in a slightly different lens, right? So if things don't go exactly right, at least when something maybe is a speculation, and then when it has more investment merit, or vice versa.
What's your today's another issue you talked about Meta? You mentioned 5% of their borrowing cost. What's the reason you put that information there?
I was just trying to show you that, like, if they wanted to borrow more money, again, doing a theoretical view of what, like, if they wanted to do if Mark Zuckerberg came in today and said, I'm going to buy out all the other shareholders and take my company private, right? Could he have borrowed it? Maybe he couldn't borrow all of it. It's 5%, maybe 6%, 7%, right? But remember, the stock was trading at a 12.5% yield, right? And if you're Mark Zuckerberg, you don't have to buy 100% of those shares because you own like 20% of it anyways. So you have to buy out 80% of the company. So you could have between 5% and 12.5%, there's probably some level where you could have borrowed the entire market cap and just theoretically, at least theoretically, just taken Meta private.
And another thing I saw from the Meta, that actually the return has come from the multiples. Like if you bought low multiples, and if you like hold it, and if it goes up, then the main source of return is coming from the multiples. That's my understanding.
Yeah, that's right. That's right. I mean, you look at Coca-Cola too, right? In Coca-Cola's case, again, it was a phenomenal stock, at least over like the following 5 years, right? And the earnings did go up, right? But more than 50% of the stock price appreciation really was the multiple, going up, right? Starting from a really low multiple is very, 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 very helpful to having really strong long-term returns, or at least intermediate term returns. So sorry, MD. There's a couple other people who have questions, so let me go to them, and then let me get back to you. David, and then I'll go to Shanla, and then I'll go back to Joel.
Yes. First off, thanks for a great 8 weeks. It was really an amazing journey through this course, and I really appreciate it. And the next set of students will be very lucky with this course.
Thank you.
I was wondering, I know we've been focusing mostly on the growth stocks. I think we did talk a little bit about cigar butts. So like a company that might not be growing, do you just pretty much ignore that whole set of companies pretty much, or just spend only a little bit of time if it seems to be very interesting to you?
Yeah, I mean, look, what I would say is this, right? You don't need to invest in very, very high growth companies, but companies that aren't growing at all, or really, or shrinking, to me, that just means that as soon as they solve one problem, they're dealing with another problem, and they're constantly, like even just having a little bit of growth really helps with dealing with problems. It's like just having a little bit of momentum to get over a speed bump, right? Versus a company that has no momentum, really getting stopped at a speed bump. So I I I know there are people, who make a lot of, who've made money, when you buy a cigar butt really low, and you can flip it. But one of the things that Buffett has said, and other people have said too, is like, time is really um, time is the friend of the good business, right? And if you have a, let me give you an example, right? I think a clear example, right? If you have a stock trading at 50 cents that's actually worth $1, right? And it goes from 50 cents to $1 in a year, that's a phenomenal return, right? You made 100% of your money, right? If it goes to 50 cents to $1 in 2 years, that's also a phenomenal return, right? You made you made 25%, or 50% in per year, right? If it takes 10 years to double, right, then it's an okay return, right? You made 7%, right? If it takes 20 years to double, then it's a pretty lousy return, right? And so the problem with cigar butts is you never know how long it's going to take, or if you'll ever be right. And then the problem is, that dollar, as time goes on, is, the dollar doesn't go up in value because the business isn't growing. And maybe the business, which is stagnant, starts to shrink. So the dollar really becomes 95 cents, becomes 90 cents, and then all of a sudden, you bought it at what you thought was a really low price, right? And maybe it turns out to be not that low price, right? Like the reason why I think it's important, or at least it's somewhat valuable to focus on companies that are growing is, if I buy a business at, not 50 cents, but even I'm buying it at 80 cents on the dollar, but I know that that dollar next year is going to be $1.10. The year after that it'll be, maybe $1.20 or something like that in value because the business itself is growing. And then, maybe the 80 cents doesn't go up for a while, but then it catches up, right? And so not only do I capture the gap, right, but the gap keeps getting wider, so there's more, more potential, at least at some point, to capture it, right? So that's if I don't know if I don't know if that was clear, but hopefully that was at least somewhat clear. And if not, I'll post something on Canvas to kind of hopefully better explain it in writing. But why, I think that for the most part, right, unless you really know, unless you have a really good reason to know why that gap is going to close imminently, right? Meaning, I'll give you an example, right? If you yourself are buying the stock at 50 cents because you're going to take over the company and then you're going to liquidate it, and you know that when you liquidate it, you're going to get $1 worth, right? Then you yourself are controlling the time, right? And so if you know that I'm going to take over this company and I'm going to liquidate it in 1 year, and I'm going to double my money, it's a phenomenal investment, right? But if you're a minority investor and you don't know when something good is going to happen, then you run the risk of just staying stuck in it for a very long time and not generating return.
Yeah, that makes a lot of sense. Thanks.
Yep. Shalom,
Hi.
hi.
Thank you very much. And the class is really excellent. So I agree with
Thank you. I'm glad.
David. So,
Thank you.
and okay, two questions. They're sort of not related, but first of all, is the circle of competence. Do you yourself stay within a very small circle? I'm asking because, I'm an architect. If I want to stay in the architecture industry, I probably don't have anything to buy.
Yeah, you'll be, but okay. But here's, here's where, we go back to some of the things like Peter Lynch would say, right? You're an architect by training, so maybe architecture from your profession, right? But you're a consumer also, right? You're an observer, you're an educated person, you're always out there. And I would say that, it's not to say that your circle of competence is static either, right? As you study companies, as you learn to invest, right, things like that. I mean, I think one of the things that we, or at least from my perspective, and I think from most people's perspective, they want to do is they want to continue to widen their circle of competence, right? So that's why if you like investing, right, you probably like following companies, right? And just because you're following a company today and you don't know it doesn't mean you don't ever learn, right? Because every time that goes by, you're learning a little bit more about a company. I didn't know anything about retail, and so slowly, you learn about like what are things like comp store sales, what is square footage, right? Like, you learn about like how does the business like react. Is it economically sensitive? What are the type of consumers that shop here? Like that's an example, right? Or, I mean, the first time you learn about Meta or something, you don't know what DAU or MAU or anything like that means, right? But then you kind of figure it out, right? And the beauty of it is that nowadays, like everybody has these wonderful tools, right? you know, Chat GPT, what does DAU mean? Explain it to me, right? Like, so I would say that yes, you want to stay within your circle of competence because there's obviously companies that have lots of different drivers and you may or may not understand them, but I also think that it's very easy, right? Nowadays, and we talked about, kind of the informational edges all getting reduced and why investing has become a loser's game. But one of the things that also helps, right, is it's so much easier for the small investor, for the individual investor. If you want to get an earnings call transcript of a certain company, you can now get a transcript. You can put it into, you can read it yourself. You can put it into Chat GPT. You can get a summary. You can say, I don't understand. What is the person trying to say here? Right. So it's easy in some ways, in a lot of ways, it's much easier to build up your knowledge faster than it would have been before. Right.
Okay.
And there's so many resources out there, right? Like if you want to learn, like, there's a tremendous amount of resources and all kinds of different things, right? So I would say that I think that it's not, I guess my point is it's not impossible for anybody, to learn and continue to grow their circle of competence, right? The other thing, again, if you remember going back to, Buffett at the very end of the class I did on just the different Buffett examples, right? He talked about real estate, right? And he talked about the farm that he bought, and he said, I knew nothing about farming, right? And he's like, but when you're buying it, especially when and this is also where margin of safety really compensates for our own ignorance to some degree, right? If you're actually investing with the true margin of safety, right, you don't necessarily need to know everything about like how this business operates and things like that, right? Um, because hopefully the margin of safety, the price compensates for it, right? Like, he did the investment in the the New York City real estate too, right? And it was like, oh, this is, property adjacent to NYU. I knew NYU wasn't going to go anywhere, and like the largest tenant was paying a fraction of the rent, right? And that was, do I think that that was literally all that he knew? No, I'm sure he knew more than that. But, you didn't need to know every little granular detail to figure out that this was a very solid investment, is, I guess, my point, right? And so, a lot of people have asked, well, like, how do you really think about the future and things like that? And I always come back to, well, it's easy on one level to think about the future, especially if you don't have to think about it too hard, right? I mean, I've used the example. It's like I don't really know if tomorrow is going to be colder or warmer than it is today, but I feel pretty confident that by next August it's going to be warmer than it is today, right? So I don't need to tell you like how much warmer or what the temperature was going to be or something like that. I just know it'll be better, right? Or it'll be warmer or something like that. Right now, I just know it's cold as hell. So, um, yeah, I would say that yes, I think it's important. You should stay within your circle of competence. It's easy to widen your circle of competence, or at least easier. I'm not saying it's easy, but then also when you're investing with a margin of safety, you can also compensate by not having as much of a circle of competence.
Yeah, understood. Thank you. So, sorry, next question is that
Okay.
how do you consider leadership? For example, if you have two companies with exactly the same metric, one has a Steve Jobs sitting on top, do you give them different considerations?
It's really hard. I mean, I'm sure to some degree you should have some value for Steve Jobs and things like that. But the other thing is, you never want to be also involved in a company where the company's completely dependent upon the CEO, right? Because like I said, CEOs, they retire, they make a lot of money, and they decide they want to kind of enjoy the good life, right? They get bored, right? They get hit by a bus, heaven forbid, or something like that. So yeah, I mean, look, I think clearly it matters, right? But like, looking at, you use the example of Steve Jobs, right? Like, looking at that, right? Like, I mean, Apple clearly needed Steve Jobs when he first came because it was kind of, a company going in the wrong direction, right? But when Tim Cook took over, right? I mean, yeah, it was sad when Steve Jobs passed away, right? But Apple had its, some of its best years after Steve Jobs was gone, right? So I think it really also comes down to just, the quality of the business, right? Like, I mean, people have said this before, right? You want a business that's so good that even the dumb nephew can run it, right? Because someday, he will, right? And so ideally, you would like to find those kinds of businesses that, would do well, right? I mean, we talked about NVIDIA and, how Jensen Huang is so phenomenal, right? But, at least for now, right? NVIDIA would do completely fine even if Jensen Huang wasn't around, right? Because there's just so much demand, and they basically control, their sector of or their portion of the AI ecosystem or something like that. Joel, I see you have your hand up, and then MD, I'll come back to you.
Oh, thank you. So I'm going back to the Meta example because I really like it, and I like the simplicity of the Gordon growth model. I had bought shares of Meta back when it was like $90. So I didn't have this simplistic model, so I like this. But and so it according to your numbers, it's a fantastic buy at the bottom. It's not a good buy. It's not cheap. If as it
It's
appears.
different. Listen, it's just different today. It's different, right? Like, the concerns that people had about, ATT privacy, the concerns that people had about TikTok just completely decimating them, right? Also have gone away, right, to some
Yep.
degree. And the excitement about AI, right? And at least, maybe until recently, right? But people's perspective was that, well, maybe Meta will actually be one of the leaders in AI, and they'll be one of the first to monetize it because, whatever they invest in AI, they can use in their ad system and stuff like that. So it's different, right? But it's clearly not, you should not have the expectation that, if you made, 3x, 4x your money over the last 2 years, that, over the next 2 years or even the next 10 years, you're going to 2x, 3x, 4x your money. It's just different, right? The starting points are completely different.
Right. But when I look at it now, if I didn't have any shares and I was going to buy it today, it wouldn't look like it would look like it's overvalued. Just using your example of the yield, the
Yeah.
earnings yield in
Yeah.
So, like I'm trying to figure out, evaluate when to sell. 'Cause I sold way too early, but I'm just trying to, from your numbers and your model, I just want to get your thoughts on how to, do I wait until it gets from a 10.1 after tax earnings yield to 5%, 6%, or what do you usually think?
Well, I
How do you
mean,
think that through?
you also have to this always comes back to what's your opportunity cost, right? Like if you sold it today,
Yeah,
remember, you sell it today, you're gonna pay sounds like you'll end up paying a big tax bill, which is a nice problem to have,
yep,
right? And then and then you'll have to redeploy those assets, right?
right,
And so the question is like, what do you see out there today, right? That you would want to use the money for, right? Basically what I'm saying is don't sell until either either you're going to say like, look, I'm just selling because this thing is so overvalued and I'm just going to
yeah,
take the money and just put it in the index or put it in bonds or something like that, or say I'm going to sell it because Google is now trading at like a crazy low price, and like
yeah,
I think I'm just going to make a ton of money if I invest in Google now, right? Just as an example, right? But like, I guess that's the whole thing, right? Is you got to think about what your opportunity costs are, right? And like, you'll say today, well, the returns in Meta aren't that great, right? But if the returns in everything are not that great, then like, you're just selling, one low return to buy something else that's a low return. And the real problem is we just live in a low return world, right? So
got it.
say until you find something that you think is a high return, right? Either stay put, or maybe you just want to deploy those proceeds into, just the index, the markets,
Index. Yeah, yeah,
diversification, and not have like single company risk or something like that.
yeah, yeah. Okay, I guess I got to get my strategy would be to sell it and put it into an index, but I'm still trying to think through based on the example, when would it make sense to sell it and then move it into an index?
Sure. So, I mean,
So
look, what I would say is this, right? Like, again, think about what the index is going to give you over time, right? So if, I think if you want to use the simple Peter Lynch model of 7% returns in the index, right?
yeah,
Okay. Okay, fine. So, do you think that your long-term returns from Meta are less than 7%? If you say
yes,
yes, right, but then remember, right, you still have to pay a 20% tax, right?
right,
So assuming, you have a taxable, it's in a taxable account or whatever, right? So you got to look at like, okay, if I sell it and I pay this tax, and I pay this tax up front, right? And let's say let's say again, just for simple numbers, I'm measuring it over a 5-year period, right? Um, if I'm measuring it over a 5-year period, that 20% tax is the equivalent of like a 4% drag on my return.
right,
So really the way I have to think about it is, if I think I'm going to make 7% in the index, if as long as I'm making at least 3% in Meta, right? You know, after, and not pay the tax, I'm almost equivalent of paying the tax and then
right,
reinvesting the index. Obviously, there's a diversification versus single stock risk, component you have to take into account and things
yeah,
like that. But like, there is a tremendous value in deferring your taxes that you pay the government, right, as much as you can. Now, obviously, over longer periods of time, if you take that same 20% tax, you spread it over 10 years, it's a 2% drag. If you spread it over 20 years, it's maybe like a 1% drag or whatever on your return. So the longer you're going to stay invested, or the longer you want to use it at least as your measurement horizon, right, then you can also factor that in. But that's how I would at least kind of maybe try to approach the problem. None of these are easy problems to solve, but
Yeah. Well, thank you. That's helpful.
okay. MD.
Yes. Jay, my question about the Shuros are like,
I'm sorry, your question about what?
The
Say it again?
previously, Shuros has mentioned about the portfolio. So how many shares minimum you should have in a portfolio?
Like, again, I think there's no hard and fast rule, right? Like, there's some investors who, have like, 2 or 3 stocks only, right? I think it also depends, like, what do you have, right? There's lots of investors who just own, Berkshire Hathaway or something like that, because that business alone is very diversified underneath, right? And so they feel like I don't need to own a lot of different companies, right? I mean, I think there's a lot of studies out there that say, once you have more than 15 or 20, stocks, you have a pretty diversified portfolio. So, in terms of like, the volatility of your portfolio and the volatility of the market and things like that. But a lot of it just comes down to your level of comfort and how many ideas you can really find that you believe in, right? I think most people, I would argue, right, most people don't have 20 high conviction investment ideas, right? I think at any one time, if you're really being honest with yourself, you probably have maybe 1, 2, 3, or 4, right? So, but I'm not saying you should necessarily have a 4-stock portfolio. What I'm saying is maybe you own 4 stocks and then you own the index, or you own 4 stocks and you own cash, or something to that effect, if that makes sense.
Then, yes. Do you recommend uh, can you use your yield, equity yield formula for choosing between indices, like creating a portfolio and choosing the indices based on that?
Yeah, you can. Yeah, I mean, you can just think of the index as one giant company, right? You can literally calculate what the earnings yield is for the entire index, right? I mean, people do this, right? They say, what's the S&P earnings yield, right? Or what's the PE multiple of the S&P 500, right? I think right now it's probably around 25 or so, right? So a 4% yield, right? And then, you can again think about like, what is the growth rate of corporate profits, right, over time? If you think GDP growth is 4%, like I think, and if you think that, corporate profits share is not going to go up over time, then, growth rate of corporate profits will be 4%. And so you get 4% yield plus 4% growth, 8%, right? So, Peter Lynch says 7%, 8%, you're in the zip code.
And do you recommend holding the cash if I need the cash within 5 years?
Yeah, I think generally that's my answer, yes, because I think again, if you remember we use the example of Rip Van Winkle if he fell asleep over any 5 years, 10 years, 15 years, right? And basically at the 5-year mark, right, there was still a chance, it was relatively low, right? But it was still like there's probably like a 10% chance, you would have lost money, right? Once you extended your horizon out to like 10 years, right, there was only one time you lost money, and over 15 years, there was 0 times that you lost money. So, cash that you absolutely need within 5 years, and you don't want to take even, a 10% chance that, you might have, negative nominal return, right? And I mean, keep in mind, right, there's always inflation too, right? So you need to think about the inflation component of it, right? But maybe over 5 years, the inflation isn't, isn't tremendous, or, isn't as big of a drag. But yeah, I mean, I think if you absolutely want to be completely 100% safe, you might say like, this is cash I absolutely need in the next 5 years, and I don't, stocks are very volatile, right? Like we've shown this, right? Like, individual stocks can move 50%, 100% in any given period, right? Like usually, over time, those things kind of cancel each other out. But, if you really want to sleep well at night, I would say like, you should really invest with the money that you can see yourself not really needing for the next 5 years. Karthik, your hand.
Yeah.
Thank you, Jay, for a great class. Quick question to follow up on your response to Joel's question, which I thought was a great one. A comment and a question. You made the point about taxes to be taken into account, which I've heard often. But isn't that a moot point? You have to pay taxes no matter what, unless you count on passing it on to the next gen and step up cost basis or go into a lower tax basis 20 years from now, maybe. But if you disregard those two scenarios, yes, your net asset value changes today when I pay tax, but I'm going to pay the same percentage tax later on. And shouldn't the only question be, I should get out of an equity if I find a compelling another opportunity whose risk-adjusted rate of return is greater than what I am in today? And if I find something that I'm sure about, then I should switch.
It comes back to how much greater, right? Because even just, even if you have to pay the same tax, right, but you have to pay it today versus 5 years from now or whenever, right? Like, again, if it's like this question, it's like this question I have for you, right? If I think if I think that the thing that I own is gonna return me 9%, and the thing that I'm gonna buy is only gonna return me 10%, right? Is that 1% pickup worth the tax?
But I got to pay the tax anyway in 5
No,
years.
I understand, but I'm saying, but whether you pay the tax today or you pay the tax 5 years from now, right? Like just the ability to push off paying the tax, lets your money compound, because again, you have 100 cents on the dollar compounding at 9%, and then you pay a tax, versus 80 cents on the dollar, then compounding at 10%, right? You see what I'm saying?
But the total dollar amount is going to be the same. I mean, it's just the percent. You're just deferring it. I thought I did the math on the spreadsheet. Whether you pay, now and you
I
let
mean,
$10
you can,
compound.
like here's and you can run the math here, but like, again, take the numbers, take 100 cents on the dollar, and run it at 9% for 5 years, and then take that final number and pay the tax and see where you end up, and then take 80 cents on the dollar, right? Because you pay the tax up front, and then compound that at 10% and see where you end up in, let's say, 5 years, and see which number is higher, right? And so that tells you whether you should pay the tax today or the tax later. And then you could tweak the numbers, you could tweak how long you want your measurement period to be, right? But that's really it's all it comes down to is just seeing like where do you end up better off in the future, right? Are you better off paying the tax today? Like, look, clearly I would say if the thing that you're in is going to return 0, right, pay the tax today and put it in the thing that's going to return 5, right? Because 0 is going to be 0 forever, right?
Right. Okay.
Again, I don't want to be, I know, because we're over time, so I'm trying to be fast because I see like MD and Joel still have questions. But if anything is not clear, just please post it on Canvas, and I'm happy to kind of put the spreadsheet on, and at least you can run the sensitivities. But yeah, I mean, it's just it should be not overly complicated analysis. MD, I think MD and then Joel, and then if nobody else has it, we'll end it after that.
Okay. You made some comments during the lectures. I didn't get the point. Like during the volatility class, you made the comment like if we knew few companies very well, we can make great return. What did you mean by that in that class? Like when the volatility was like roughly around 50% each big companies.
Yeah, all I'm saying is, if individual stocks are fluctuating at 50% every year, and you knew you had a good sense of what was low and what was high. I'm not saying that you necessarily do, right? But my point is that, there's 50% returns potentially to capture, in individual stocks every year, right? I don't know very many, if any, equity managers who are putting up 50% returns, right? So, the stocks are giving them, the way I sort of think about it is that range that the stocks fluctuate in is a lot of raw material, right, for active investors. And, why are active investors not putting up, anywhere close to 50% type returns every year? It's an interesting question, right? Because you would think that lots of investors know Nvidia or Google or stuff like that, and you can look at these stocks even just this year, right? They've fluctuated from their highs to their lows probably at least 100%, right? But again, very few, if any, active investors, if you know some, let me know, right, are putting up 100% returns this year.
Another comment you made, if the market crashed 50%, most of us would be better off today. You will probably have more of your investment future ahead of you than behind of you. When the stock price is lower, the company can grow faster. In the retirement, you will have more money than other way around. What did you mean by that?
Yeah, basically that, most of us are probably still in our savings periods of our life, so we're still earning income and investing. And so if you can invest at a lower price, you're going to be doing better overall, right? It's the same as just buying a stock at a lower multiple, effectively, if you think about it like that. But the other thing that kind of adds into that, remember the companies themselves are themselves investing, right? They're buying other companies. They are, they're buying back their own shares, things like that. So if the stock price went down in half and the company was buying back, you know, a few percent of their stock every year, right? All of a sudden they could buy back twice as much of their stock. And so that would be a huge, long-term tailwind to whatever the underlying growth of the business is in terms of an EPS, and then that would help, that would give you a higher long-term return.
Another comment you made, that if 50% down, it will take 5% to recover and 7% earning increase and 1% dividend yield. That will give you a great return. What do you mean by that?
I'm sorry, say that again?
Yeah, if the market is 50% down, it will take 5 years to recover, and 7% earning increase and 1% dividend will give you a better return.
I'm trying to, I don't necessarily remember what that comment was, but basically I think what I was trying to say is that, even when you look at a stock that's down a lot, and you can kind of think about, like, how long does it take to get back to where it was, right? Like, so, in the case of, let's say a stock that's down 50% from where it was, if you think it can go back up to where it used to be, and you say it takes 5 years, right? So if it can go up, 100%, basically doubling over 5 years, right? That's a 15% return. That's a great return, right? And so, I think that's the point I was trying to make, but I don't remember the broader context, so I'd have to go back and look at it. Joel, I'll go to you, just because, again, I know we're already over time and people are dropping off, so I just wanted to be sensitive.
Okay, thank you. I'm always trying to figure out how to find stock ideas to analyze. And
Mm-hmm.
so one of the things I do is I look at a tool called Dataroma, or a site called Dataroma, to see what the famous investors have just bought. Basically looking at the
Mm-hmm.
recent investments, and then I can pick out a few to analyze and see whether it's worthy of investing or not from my perspective. But what do you do to get ideas to look at?
Well, I mean, this kind of goes back to what we were talking about with the equity yield curve, right? Like, I like looking at stuff that people, like, when you talk about it, right? People's gut reaction is, oh my God, like, why would you invest in something like that, right? Like that's actually what, when you were, I mean, it sounds like you kind of invested in Meta like near the bottom and things like that, right? I'm sure there were some people who were like, oh my gosh, like what are you doing? Like you're worried about TikTok, aren't you worried about like this? Aren't you worried about that? And there's a lot of fear, right? Things that there's a lot of fear about, right? So I spent a lot of time looking at, you know, you know, when when Obamacare was going into effect, right? People were very nervous about what was going to happen to healthcare companies, or when different things are going on, different companies are economies are in a recession, companies are in a recession. Basically, when the average person remember that the average investor wants to buy things because they think the near term news is going to be good, right? And so I like to look at things where I think the near term news is going to be bad, but where I also think that the bad news is, or is either fixable or is temporary, right? Because those are kind of those opportunities where most of the professional investors, most of the retail investors will be avoiding, and the things that people are avoiding are usually the things that become undervalued or mispriced. So, that's at a very high level, but, you could read you could be reading the Wall Street Journal or,
Yeah, okay.
news or
Yeah.
whatever, and you'll always see bad things happening, right? With different companies, right? And companies, individual companies have bad earnings reports. You have CEOs who abruptly resign. You have, companies who are coming under some sort of competitive pressures. Um, you have companies that were going to get acquired and then the buyer decides to walk away. All of these are just examples of areas to start investigating, right?
Got it. Okay. That's very helpful. Thank you very much.
Of course. MD, you got the last question of the class.
Yeah, okay, thank you so much. The question is, do you recommend any other letters besides the Berkshire Hathaway letters for learning the investment philosophy?
Oh gosh. Okay, I will tell you this, okay? Yeah, I mean, look, you could read Howard Marks, he's put out a lot of memos. I mean, obviously Peter Lynch, he doesn't have letters, but he has, he had this magazine, he had this magazine column and he's written a couple of books and stuff like that. So what I would say is, you can read all these people, but in the end, at least from my perspective, I think you probably know a lot more about investing than you think you do. And so you could spend your time looking at all these great investors of the past and, get buried in like what they did and stuff like that. Or you can spend that time, looking at investments, right? Because again, I think, hopefully you're going to leave this class and you already have a good rational framework for how to evaluate investments. And so now, I mean, sadly, there's only 24 hours in the day, and I don't know about you guys, but I still need a good amount of sleep. So, there's only so many hours in the day that I can allocate to what I want to do. So, really, what I would say is, yeah, it's always interesting to read what other people have said and done, but in the end, if this is an investment approach that you believe in, then I'd tell you, I think you're better off just getting to it and just starting to read about companies and investments and what's going on more than reading other stuff, or at least maybe save that for the weekend or something like that when you want to read something more for entertainment or something like that.
Thank you, Jay. I really appreciate from bottom of my heart. You gave me completely different alternative investment strategy for my life.
Okay, well, that's great. That's the whole. Listen, my whole reason for wanting to teach this class is because I think there's so much misinformation and so much overcomplication that I think goes into investment education today. So hopefully this gives you something. Hopefully you'll tell your friends. Hopefully I'll get an opportunity to teach this class again. down the road. And you know, like I said, I'd love to stay in touch with all of you guys. So please, you know, feel free to reach out. And again, for the next couple of weeks, you know, I'll have access to Canvas. You guys will have access to Canvas and stuff like that. But really, really thank you guys all for taking the time to listen to what I had to say.
Thank you so much, Jay.
Thank you.
Of course.
Thank you.
Have a good one. Thank you guys.
Okay, thank you.
Have a great night.
Thanks.